There has been an uptick in activity on IPOs coming to market. Karina Mitchell was on hand as the NASDAQ welcomed the newest addition to the tech-heavy exchange and found out why the timing is right for this South Asia-based company to list in the U.S.
It was a moment of celebration for the team at Money Hero, marking their debut as a publicly traded company by ringing the opening bell at the NASDAQ in New York. Both the CEO and CFO say it felt like a full-circle moment.
It's an amazing feeling. I mean, we've been working, for over 8 years now on building this company, and finally we've reached this, amazing milestone.
The journey is hard, and as I was pressing the bell, all I could think of was the flashback of all the sacrifices the team has made.
The Southeast Asian fintech company, founded in 2014, is headquartered in both Singapore and Hong Kong, with additional operations in Malaysia, the Philippines, and the Taiwan region. The listing gives it an enterprise value of more than $300 million. It made the decision to go public in the U.S. backed by Hong Kong billionaire Richard Lee and PayPal founder Peter Thiel via special purpose acquisition company.
Through merging with a SPAC, we were able to secure a very sizable amount of capital, about $100 million in gross proceeds, in a very difficult market environment.
Money Hero's initial public offering comes after a more than year-long global IPO drought, and after two other recent high-profile IPOs, British chipmaker Arm and grocery platform Instacart, saw their stock prices fizzle after initial fanfare. But Agarwal says he believes Money Hero, which operates various personal finance platforms that recommend services such as credit cards, personal loans, and mortgages to its users, is positioned to succeed.
What is unique about your company that usually will drive growth?
I think we're only scratching the surface right now. If you look at the region, the Southeast Asia region is the fastest growing region. It has substantial amount of young and driven population, a lot of new to bank, new to financial service population, and the economies are still growing. So we want to be a part of that upliftment of the entire economy.
Agarwal says that upliftment comes with some big goals for the future, including expanding its footprint in Southeast Asia.
As I was just talking to some of my colleagues, I said if we were a Netflix series, this was season 1. I think season 2 starts now, and it has to be more exciting, bigger, grander.
Karina Mitchell, CGTN, New York.
For more about the markets and IPOs, Sean Stein Smith, assistant professor at Lehman College, City University, New York. Welcome back, Sean. Good to see you. Hey, we got a lot to cover here, so I'm gonna go quickly here. Let's start with the IPOs. We had Instacart, we had Birkenstock, we had Arm, and arguably none of them have really been spectacular, with the most recent one, Birkenstock, quite honestly, being a failure. What's going on?
I would say there, Phil, that these private firms are under pressure to go public as interest rates have gone up quite a bit during the last 12 to 18 months or so. That has in turn increased cost of private capital, basically forcing companies to go public that otherwise, back in lower rate eras, probably would have stayed private for longer. And so that's a big part of why, after going public, they aren't doing as well.
I mean, we're seeing public companies that probably don't want to be public anymore. I saw Norwegian Cruise Lines the other day do a debt offering, I think paying 8 or 9%. Yeah. I mean, do the math. If you're paying 8 or 9 or 10%, and these are big companies doing so on huge amounts of debt, they're going to have really big problems if rates stay to where they are at. Now, some people have said these IPOs are coming to market, they're blaming the investment banks. It's always the greedy bankers' faults, of course. But yes, they want to raise money, and they're going to raise as much as they can. But at the same time, if there's people willing to pay for it, I suppose that's the business of the greedy markets, right?
Absolutely. Yes, Phil, correct. That in order for the bankers to be in business, there have to be investors, be they institutional or individual investors, who are willing to buy at the market prices. So I would push back on the whole greedy banker narrative, right? That the actual bankers only make money oftentimes if the firm going public does well. That's a big part of it too. Those banks are often on the hook if the shares, after being offered, don't actually rise as forecasted. So it's always a bit more nuanced as opposed to just blaming one party or
Look,
another.
What I'm saying is, if you take Birkenstock, for example, everybody that participated in Birkenstock thought they were going to walk away a winner. They all walked away losers, fairly big losers, in fact. So the next time around, when I give you a call and I say, hey, I've got this company going public, would you like some? You're not going to say yes to that.
Absolutely. And honestly, Phil, higher rates are forcing investors to really look at companies, to actually look at the fundamental business models, as opposed to just, buying into IPOs hoping to capture that opening day pop. It's all about fundamentals.
I want to ask you this. If I had told you a week ago that we would have higher CPI numbers, higher PPI numbers, a war breaking out in Israel, and still the remaining conflict was seemingly still at a stalemate in Ukraine, and the markets continue to kind of inch higher, what's going on here?
So I'm no expert on politics or on how these conflicts are ultimately going to end, outside of hoping both end soon. But on the actual market side, the overall view, anecdotally, I've heard, is that most market investors are not viewing any of these headlines or any of these conflicts, as horrible as they are on the ground, as being conflicts that are going to impact any major markets or any major commodity markets. And so therefore, the overall response has been pretty muted.
The Republicans, they can't get their act together to figure out who's going to be their leader. And my understanding is if they can't get a leader, there's no deal in November, which means the government, I guess, is on the risk of shutting down again. I mean, that can't be good for anybody.
I would say not. And you're correct. If the House has no formal speaker in charge, the House cannot pass any actual laws. There are some stopgap measures that are able to be taken, but correctly to your point, if there is no House leadership formally put into place, then Congress, in essence, cannot do its actual job. And so, yes, that's going to be bad news if it does come to that.
You know what I worry about is, okay, so you have all these things, and I get it. You can block this out, you can block that out. We can make excuses I can justify almost anything, right, if you give me enough time. But at some point, all this news piles up, and one day investors say, you know what, it's getting closer to the end of the year. I had an okay year. I'm just going to cash out. I'm done. You hit the sell button. You hit the sell button, and here we go. We flush it out. Are we going to end the year higher or lower?
So I always hate making predictions, Phil, but I would say cautiously that we are going to end the year 2023, if not higher, pretty much at current levels.
All right. Are you a Taylor Swift fan?
No, I am not.
Well, I wonder what she would say about the economy. Good to see you, my friend. Have a good weekend.